In this video, we're going to be taking a look at the PE ratio. I'll be teaching you how you can quickly use it as part of your toolkit to value a company and improve the success of your investment. What's going on, everyone? Welcome back to the channel. My name is Aaron from Financial Knowledge, where I bring weekly finance and investing related advice. If you're new here, consider subscribing. All the support is greatly appreciated. The PE ratio is one of the most commonly used metrics to identify value and growth. In essence, it shows how much the market is willing to pay today in relation to the future potential growth of a company. It gives you an idea of the potential growth of that company and how much you should be willing to pay for shares in that company. Having a quick look at the PE ratio can be a useful indicator when you're selecting businesses to invest in before doing more in-depth research. Being able to effectively apply the PE ratio is an excellent way to improve the quality of your investments. So right now, I'll be jumping into some real-life examples of how to apply the PE ratio and a more in-depth explanation of what the ratio actually means and how you can calculate it for yourself. Make sure you stick around until the end, because I'll also be sharing 3 other strategies that you can use to quickly value a company other than the PE ratio. Just to give you a bit more context on this mystical formula, I'll throw it up on screen. So as you can see, the PE ratio equates to the share price of a company divided by the earnings per share. So breaking down the 2 metrics that make up the PE ratio itself, share price is just the price of one share of the company. EPS is the net income of a company divided by the total number of shares outstanding. So if a company had a net income of $100,000 a year and had 50,000 shares outstanding, it would have an EPS of 2. So putting everything together, say for example, company B has a share price of $60 and an EPS of 2. If you divide those numbers, then you'll be left with a PE ratio of 30. If you want to calculate the PE ratio for a specific company, all the information in regards to EPS and share price is readily available on websites like Yahoo Finance. And if you can't be bothered doing the calculation yourself, the PE ratio is also readily available and pre-calculated for you. Just head over to Yahoo Finance, type in the ticker symbol of the company you're wanting to look at, or just type in the ticker symbol into Google and you'll be able to find the PE ratio and the numbers that make up the PE ratio from there as well. Well, you may be wondering, how do I apply the PE ratio when I'm valuing a business? Is a higher PE ratio better than a lower one, or vice versa? I'll be getting into all of that and more right now. The PE ratio can give us some indication if a company is overvalued or undervalued, and some idea of how well the company is predicted to grow in the future. So if we take a look at the average historical PE ratio, looking at something like the S&P 500, it sits roughly between 13 and 15. So breaking it down, a company with a high PE ratio has a high share price in relation to its earnings and therefore is theoretically overvalued. And vice versa, if a company has a low PE ratio, its share price is low in relation to its earnings and is therefore undervalued. So looking at it from this perspective, you might think to yourself that companies with a high PE ratio are automatically bad investments because they're overvalued. And should you only put your money into companies with a low PE ratio because they're theoretically undervalued? I mean, it makes sense. If the share price is undervalued with a good EPS, you might as well just dump all your money into it and ignore the companies with a high PE ratio. But it's not that straightforward, because the PE ratio is not a be-all, end-all metric that gives us enough insight into a business. The PE ratio should be taken as market consensus or opinion on how the market thinks a company will do in the future. When people buy into businesses with a high PE ratio, it's with the belief that the company's EPS will grow high enough in the future in order to merit paying such a high share price, and vice versa. When people sell their shares in a company with a low PE ratio, it's with the belief that the company won't grow enough into the future, which will make it a worthwhile investment for them to hold on to. Going back to the idea that the PE ratio is more of a market perception on the future growth of a company, you can look at stocks like Tesla and Amazon, which have insane PE ratios. Amazon at the time of making this video has a PE ratio of about 115 and Tesla all the way up to 1,000. Thinking back that an average PE ratio is about 12 to 15 and something sitting at around 30 to 40 is considered high. Something in the hundreds or even in 1,000 is insane. There is not one single metric that really gives you enough idea on the strength of a company And when you're looking at businesses to put your money into, being able to correctly identify a strong business has a lot of factors involved in it. So just looking at the PE ratio kind of sets you up for failure, and you want to be looking at a lot of other things to give you an indication if the company will be a good investment or not. So keeping things in mind, like what is the long-term strength of the business? Will it be around not just 1 or 2 years from now, but 10 or 20 years into the future? And what is the strength of the management team? Because ultimately, when you invest in a business, you have faith that the management team will be able to correctly use the money that they have to grow the company and also grow the investment that you've put into the company. And finally, are you paying the correct share price for the business? Is the company currently overvalued, or does the share price match the actual value of the business and the potential growth that is able to come from the business in the future? Remember, if you find the content useful and have learned something new, make sure to leave a like on the video and let me know in the comments, how do you guys value a company? Do you look at something like the PE ratio, and what other methods do you use when you're looking at businesses? I'd love to hear from you guys, and I reply to everyone that leaves a comment on the channel. So hopefully this video gave you a bit more context on what the PE ratio is all about, and you're feeling a bit more confident using it when you're looking at different businesses. As always, if you found the content useful, subscribe to the channel, and if you want to check out any more future content, feel free to click the links on screen, and I'll see you guys in the next video.